Okay, hello class. So now we're going to look at chapter 2. Chapter 2 is dealing with job order costing. And this chapter actually has the main chapter itself, and then there also are two sections of appendices that we're going to go over as well. So let me go ahead and share the slides with you. Oops. Okay. So chapter 2, job order costing, calculating the unit product cost. And we talked about this kind of dovetails into what we looked at with chapter 1. But we know that managers need to assign costs to products, and they do that in order to help to facilitate internal decision making and external financial reporting. And so we're looking at absorption costing approach to calculating uh, product costs known as job order costing. Then remember that fixed and variable costs. So a fixed cost is one that's not going to change based upon the number of units that are being produced, but a variable cost will. We talked about that before. So first of all, job order costing systems are used when many different products are going to be produced during each period. Products are manufactured to order, and the unique nature of each product, of each order, requires tracing or allocating cost to each job and maintaining cost records for each job. So, okay, actually, I'll go into what I was going to say in the next slide, is examples of where we might see this. So again, examples of companies that would use job order costing include aircraft manufacturers, large-scale construction companies, and then also could be companies that produce business cards or any kind of a company. But again, looking at this, for example, with Boeing, let's say even across one particular type of airplane, let's say it's the Boeing, what is it, the 787 or whatever it is, the Supermax, the new plane that they have. Yes, each plane is very similar and it contains most of the same parts, but they actually, believe it or not, are build to order for whatever particular airline. And that was an issue that actually came up uh, probably about a year or two ago, where we had with Boeing, they had a door plug that came off the airplane, that departed the airplane while it was being in flight. On some planes, that is an actual door. And on the planes that Alaska Airlines had, it's not an actual door, but yet a door plug where a door could be. But Alaska Airlines has chosen to have it not be a door. So they put this thing in there. So the planes are all slightly different. You could do that as well. For example, Dell might do that. If you order a computer from their website and you specify the amount of RAM, the amount of storage that it has, any other components that it has, different than what maybe I might order. So then that would necessitate a custom order or a vehicle. They might do that. If you order, let's say, a car from Toyota and it's a specific model and you specified the color and other options, those would be it. So they would use a job order to do that. In construction, you will do that because, again, based upon each construction project is going to be different. I know we just went through it, and some of you might have class if you have classes on campus in this building. I know I was there last Friday, just kind of being nosy. Anna and I saw that we've moved into it, the vocational building on campus. We just went through a multi-million-dollar project to renovate that building, and it was desperately needed. Obviously, there was job orders in terms of, how everything had to be. They had to track what they spent on, what the construction company spent on everything. And then, of course, they ran into a lot of things that were unexpected, different issues that they had to go in and correct. So again, in keeping track of those costs. Vista, a company like a printing company, might use job order because each of their jobs might be different. So, for example, Vista Print, they make business cards, but they also make a lot of other types of products as well. They make magnets that you can put on the side of an automobile. They make business cards, t-shirts, hats, all kinds of things. Each one of those is going to be different. Even within business cards, it's going to be different. I know I have had some that had like foil on them, and so it was printed in such a way that it had foil. So that's going to be a different cost. So it's done anything that's customizable, we we would we can use job order costing, and it's a good way for us to use it. Another way that you can use it is process costing, and we'll talk about that later. And there are other types of products that lend themselves better to that way. And we'll look at that at that time. But anything customized, we can use job order. Okay, so we see here that the types of manufacturing costs that are assigned to products in job order costing system are the direct costs, which would be our direct labor and our direct materials. Direct labor is traced directly to each job as the work is, excuse me, direct materials is being traced to each job as the work is being performed. So as the work is being performed, we know how much materials we're using for that. For direct labor, again, is also can be traced directly to each job. So we know how much labor goes into each job. But we also have indirect costs. And an indirect cost would be, it might be manufacturing overhead, which would include indirect materials and indirect labor. Those costs would be allocated to jobs rather than being traced specifically to each job. So you would average it out over a series of jobs. And so that might be maybe the lubricant that is used on a machine. That would be a indirect material. We don't know how much of that actually goes into each job, but we have to use it. Or labor for a maintenance person. That is important. It's being used, but it is not specifically to each job. And you might have something like this, either a piece of paper or something that is in some kind of a computer system. And of course, nowadays everything is done on a computer, but it could even be a slip of paper. If you're in some places like a machine shop or something, it could just be a piece of paper. Or I know down here it's doing service rather than manufacturing, but they could do the same thing. Is down here at the little hardware store, they uh, the gentleman there, he used to do a lot of small engine repair. So he would repair if you brought in a weed whacker that needed the engine, something done to the engine, or a lawnmower or a chainsaw. And he might have a sheet like this to fill out. Okay, this is what parts I had to use. This is how much time I spent, and so on and so forth. And that would be something done on paper because that's just how that business operates. It's very small. So everything there is I'll talk more about that particular hardware store maybe later on because it's kind of interesting how they do things. It's all very, very manual process. But Anyway, so you'll fill out something like this, and so this tracks exactly. This is a job cost sheet. The accounting department relies upon a job cost sheet for tracking of direct and indirect costs. And again, it might be a piece of paper, might be on a computer, like our example here is. And again, an overview of a job cost sheet for a hypothetical company called Youst Precision Machining is what we see here. So a job number uniquely identifies each job. So each job is given a unique number. And then the amount of direct materials, direct labor, and manufacturing overhead costs are accumulated for each job. And then the job cost sheet is a subsidiary ledger to the work in progress account. So eventually it will make its way into our accounting system. One other thing that we might have to do is we also have to requisition materials. So we're taking materials then out of our materials inventory and then allocating them then into each job where they are used. And again, this could be done on paper. This could be a little card that gets filled out, or it could be like this again as part of a larger ERP solution, accounting solution. We can see that. So we see here that once a sales order has been received, a production order is issued. The production department then prepares a materials requisition form to specify the type, quantity, and total cost of materials. And so in this case, we know that the total materials is 660, but we see how many of each housing and connector that they need in order to be able to do this job. So then these materials then are drawn from the storeroom. The job number 2B47 is where the cost for the materials gets charged to. For an existing product, the production department can refer to a bill of materials to determine the type and quantity for each item of materials needed to do the unit. So if there's certain uh, unit of products, so if there's a certain item, certain product. So for example, I'll just kind of hold up an example. Apple computer, but they don't go by that. But Apple, they make iPhones. And in whatever iPhone this was, I don't know what was this, the iPhone 15 or whatever this was. I don't even know. Um, if I want to make a run of these, I know what materials go into them versus I'm making a bunch of, I don't even know if they even still make them anymore. The iPhone SE has a little bit different materials. So Apple would have something called a bill of materials that lists out all of the materials that go in that particular product. But they could use, again, the same thing in order to requisition those materials to be able to make the product. Or actually, wouldn't be Apple. We know that they use another company to actually build their stuff, but we see that. So but you could do that. If it was a known item that you're manufacturing, you could have a bill of materials for that. Okay. So the accounting department records the total of the direct materials cost, which is a 660, on the appropriate job sheet. Notice the materials requisition number, in this case 14873, is included in the job cost sheet to provide easy access to the source document. So we can always go back and look at this. Okay, so measuring direct labor. Now, workers use time tickets to record the amount of time that they spend on each job and the total cost that's associated with each job. Okay, right here. So this is an example of a time ticket. So you have for the name of the employee, what station they're working, the date, the time ticket number, and then again, what jobs listed, what it is that they are doing, and how long they are doing that. And so this tells you then that for job 2B47, we have $90 worth of labor. Okay, so this gets filled out. And again, it could be a piece of paper, Or it could be something where maybe they have to scan the job ticket or scan some kind of a barcode and then they scan their ID or something. It could very well be like that as well. Okay. And so all of that information then gets put back into this job cost sheet. So moving along, so the next section then is computing the predetermined overhead rate. So an allocation base, and again, for this, we can use either direct labor hours, direct labor dollars, or machine hours, and you'll choose which one is going to work best in your situation, is used to assign manufacturing overhead to individual jobs. And so in our homework, of course, they're going to tell us which one they want us to use. But in a real world, you'll choose whichever one fits best within your scenario. Now, we use an allocation base because it is impossible or difficult to trace overhead costs of particular jobs. You're not going to do it. It's just going to be for those particular jobs. Also, manufacturing overhead consists of many different items ranging from grease that's used in machines to the production manager's salary. So all of those are things, and you're not going to be able to quantify exactly how much goes into any particular job. And then also many types of manufacturing overhead costs are fixed, even though output fluctuates during the period. So for example, the production manager's salary is going to stay the same regardless, because he's paid a flat rate every month, regardless of how much production actually goes through or not. So the predetermined overhead rate is used to apply overhead to jobs is determined before the period begins. And this is where it gets tricky because this is done before we've done anything. So this might be determined maybe at the beginning of the year for what we're going to do for that year. So there's a lot of things that we don't know what the costs are going to be. Obviously, we don't know the cost for our utilities, our electricity, our water, our natural gas for heat, all of those kinds of things. We don't know what that is until later. We just have to do our best to try to look at what happened in the past in order to use our best judgment to judge it. So the predetermined overhead rate is calculated by dividing the estimated amount of manufacturing overhead for the coming period by the estimated quantity of whatever allocation base we use. So again, either labor hours, labor dollars, machine hours, whatever works best in your scenario. And then that's what gets applied. Ideally, the allocation base chosen should be the cost driver for the overhead. So again, if what you're doing is very labor intensive, then you could use either labor dollars or you could use labor hours. As we know, a lot of production nowadays is done via automated means. So then you would not want to use either labor hours or labor dollars. You would want to use machine hours because if you're using a process that is highly automated. So and that's what you're going to look at your cost driver to figure out what your allocation base is going to be. All right. So predetermined overhead rates that rely upon estimated data are often used because the actual overhead for the period is going to be unknown until the end of the period, thus inhibiting the ability to estimate job costs during the period. We also know that the actual overhead costs can fluctuate seasonally, thus misleading decision makers. And again, that can be because maybe we have to use more heat in our facility in the winter than we do in the summer, or we have to use a lot of air conditioning in the summer. Obviously, during the winter, you're not using that. So your overhead can fluctuate based on that or based on how much the machines are being used and so on and so forth. Okay. So predetermined overhead rates are calculated using a four-step process. And so we see here that the first step is to estimate the total amount of the allocation base that is required for the next period's estimated level of production. So again, figuring out, okay, the number of hours, the number of dollars, so on and so forth, whatever it is. The next step is to estimate the total fixed manufacturing overhead cost for the coming period and then the variable manufacturing overhead per unit. So you take how many units you're going to produce, and that's what's going to be in that. You're going to figure out how many units you're going to figure out, and then figure out fixed cost, which could be salary, could be anything, possibly rent for your facility, so on and so forth. The third step is to use the cost formula to estimate the total manufacturing overhead costs. So that would be Y equals A plus BX. So Y is the estimated uh, total manufacturing overhead cost, which we're trying to find out. A is the estimated total fixed manufacturing cost plus the estimated variable manufacturing overhead cost per unit of the allocation base, and then X is the estimated total amount of the allocation base. So X would be the number of units or the number of hours or what have you. And then fourth then is you would go ahead and compute that. So we see we'll start working this out here is how we actually do it. So again, manufacturing overhead is applied to jobs. Oops. Okay. So manufacturing overhead is applied to jobs using the predetermined overhead rate multiplied by the actual amount of allocation base used completing the job. This is called a normal costing system. For example, in this example, Yoast Precision Machining, they would apply the overhead to jobs they use direct labor hours. And so they estimate that 40,000 direct labor hours would be required to support the planned production for the year. And they estimate that 640,000 of the total fixed overhead cost and $4 of the variable overhead per direct labor hour. So $4 an hour is overhead, and then 640 is the total fixed. So we can use the cost formula then, and we see how they did that. To work out what would be in parentheses first. We work that out first, plus the which is the BX would be in parentheses. So we work that out first, plus the total fixed cost, and that's what's going to give us our total estimated. And then we can divide that into the number of estimated direct labor hours or whatever the base is. And that gives us $20 per direct labor hour. And then they would record that $20 here for how many manufacturing overhead for how many hours the job total took. Okay. So now we'll look at the total cost and unit product cost for a job using plant-wide predetermined overhead rate. So then we would complete our cost sheet. And so the total direct material, direct labor, and manufacturing overhead costs for job 2B47 is 2,390. Now, since this job includes 2 units, the average cost per unit is 1,195. And so we see that here for 1 unit and we see that how they work that out. The average unit cost should not be interpreted as the cost that will actually be incurred if another unit was produced, because again, it would be different. The fixed overhead would not change if another unit was produced. So the incremental cost for another unit is something less than 11.95. Remember, the fixed cost is fixed. It's not going to change based on how many units, but the variable will. So just kind of be mindful of that. So we see the total cost for the job and then the fixed cost. Okay. So kind of a quick check here. So job WR53 at NW Fab Inc. requires $200 of direct materials and 10 direct labor hours at $115 per hour. Estimated total overhead for the year was 760,000 and the estimated direct labor hours were 20,000. What would be recorded as the direct labor cost? And so the answer would be $730 because you're going to take the 760,000 and divide that by 200,000 hours. And that's going to give you, so that'd be $38. And then you have, that's the overhead rate. And then you have the production, the direct materials, direct labor, and then the overhead rate times number of hours. And so that's what's going to give you your total cost. Okay, job order costing a managerial perspective. So one thing we have to be careful of doing is if we inaccurately assign manufacturing costs to jobs, inadvertently influences planning or adversely influences planning and decisions made by managers. So it's important that we are very careful in making sure that we match the costs with the jobs. So job order costing systems can accurately trace direct materials and direct labor costs to jobs, but they often fail to accurately allocate the overhead costs used during the production process to their respective jobs. And the reason for that is it's difficult because it's hard to judge. And as I've mentioned already, it's difficult to judge exactly how you you have to figure out, make sure you're using the right base, make sure you're using good judgment in determining the amount of overhead or what the costs are. So we see that job order costing systems often use allocation bases that do not reflect how jobs actually use overhead resources. The allocation base in the predetermined overhead rate must drive the overhead cost and help to improve job driver or job cost accuracy. So again, it has to match what it is. So if it is a labor intensive type of production, you can use either labor hours or labor dollars. If it is one where everything's machine mechanized, automated, you would not want to use direct labor hours. You would use machine. You might want to use machine hours. So the cost driver is the factor that causes the overhead costs. And many companies use a single predetermined plant-wide overhead rate to allocate all manufacturing overhead costs to jobs based on their usage of direct labor hours. But it is often overly simplistic and is incorrect to assume that direct labor hours is the company's only manufacturing overhead cost driver, because oftentimes there might be more than one cost driver or differences in some jobs might be more manual or some types of products might be more manual than others to produce. So just being aware of that. If more than one overhead cost driver can be identified, job order job cost accuracy is improved by using multiple predetermined overhead rates. So you might use one overhead rate and then you might use another in combination with it. And we'll look at an example of how we might go about that. So job order costing using multiple predetermined overhead rates. So a cost system with multiple predetermined overhead rates uses more than one overhead rate to apply overhead to jobs. For example, assume Dixon Company uses job order costing system and computes a predetermined overhead rate to each production department. The company uses cost plus pricing to establish selling pricing for all of their products. So we see here that information related to the two processing departments is shown here. So we have milling and assembly, and then each one has different costs, and then we see here how they do it. Milling bases theirs on machine hour because that's more of a mechanized process, whereas assembly is more of a uh, process that's done, has more involvement by people. So they would use direct labor hours. And then we see here. So you can use that in order to calculate then the costs of overhead for your product. So the first step is to calculate the predetermined overhead cost within each department. And that you can see here, that's what we have the information for. Then we have it now. We just want to know what the total cost is. So for the milling department, you're going to take the 390,000 and then $2 per machine hour times 60,000 machine hours comes out to 510,000. And then for the assembly department, $500,000 of fixed cost plus the direct labor hour amount for direct labor hour times the number of direct labor hours is 800,000. So during the current month, the company started and completed job 407, and we're going to use this predetermined departmental overhead rate cost and rate for the milling and assembly to work with that to figure out what the costs are. So now the next step is to calculate the predetermined overhead rate within each department. So we're going to take that cost that we figured out in step one, divide it by how many hours there are. So either the machine hours or direct labor hours. And that gets us how much per machine hour and how much per direct labor hour for each process. Now, the next step then is to calculate the amount of overhead applied from both departments for the job. So for the milling department, we have $8.50 per machine hour. And for this job 407, we use 90 machine hours. So we multiply that out, comes out to 765. And then for assembly, we have 20 direct labor hours times $10 a direct labor hour. So that would be $200. And then in step 4, you will then go ahead and calculate the total cost, the total job cost for the job. So again, you're going to add then your direct materials that are used, your direct labor that is used, and then your overhead like that we figured out before. And that will get you then what the total cost of producing that job was. From there, you can then figure out what your selling price is because they assume a 75% markup over what it cost them to make it. And so we can add our markup to it, and then that gets us our selling price. Now, it's important to emphasize that using a departmental approach for overhead application could result in a different selling price than it would be if we just used a plant-wide overhead rate based on either direct labor hours or direct machine hours. But the appeal of doing it this way is that they presumably provide a more accurate accounting of the costs caused by jobs, which in turn would enhance management planning and decision making. Okay, so okay, so we'll come to that. Now, the next thing we're looking at is figuring out multiple predetermined overhead rates and activity-based approach. So when a company creates overhead rates based on activities that it performs, it is employing an approach called activity-based costing. Activity-based costing is an alternative approach to developing multiple predetermined overhead rates. Managers use activity-based costing systems to more accurately measure the demands that jobs, products, and customers and other cost objects make on overhead resources. So job cost sheets then go into a subsidiary ledger, all or form a subsidiary ledger. All of the company's job order cost sheets collectively form a subsidiary ledger. The job cost sheets provide an overlying set of financial records that explain what specific jobs comprise the amounts that reported in the work in progress and in the finished goods on our balance sheet, and then also the cost of goods sold on our income statement. As we said. Now, the job order cost systems are often used to create financial statements for external parties. And the impact on the financial statement when a company uses predetermined overhead rate is the amount of overhead applied to all jobs for the period will differ from the actual amount of overhead costs incurred during the period. Because it's difficult, again, as we talked about, it's difficult to accurately determine what it is. So there's possibility that it could and will differ from what actually occurred. So when a company applies less overhead to the production than it actually incurs, it creates what is known as underapplied overhead. So if we apply less overhead than what we intend, it creates unapplied overhead. Now, when it applies more overhead to production than what actually occurs, it results in overapplied overhead. And the cost of goods sold reported on the company's income statement must be adjusted to reflect the underapplied and the overapplied overhead. The adjustment for underapplied overhead increases cost of
Amber added
cost of goods sold and decreases net operating income. The adjustment for overapplied overhead decreases costs of goods sold and increases net operating income. And in the same thing, what we looked at can be used also in manufacturing firms as well, or in service firms. So, for example, a law office, each client's case might form a job. Legal forms and similar inputs represent direct materials. The time expended would be the attorney's direct labor. The costs for secretaries, clerks, rent, depreciation, and so forth would be the overhead. So it works very much the same way.